What's up everybody, Nate here, and it looks like plenty of public and private companies are getting into the Halloween spirit this year and dressing up as zombies.
He's a zombie.
Alright, in all seriousness, the stock market is kind of broken right now because we have seen a 10% rise globally in zombie companies. Now, what exactly is a zombie company? Well, it is exactly that. It's a company that is barely alive and only functions off of brains.
Because zombies eat brains.
Except for in this case, brains are actually investor liquidity. But right now in the United States, we have interest rates starting to go up, and that means that the entire economic environment is changing, and the worry is all of these companies, hundreds if not thousands of companies all throughout the United States and the world, are about to go into bankruptcy because they can't pay their bills anymore. And that could come as a shock to just about every single market across the globe. So today I want to talk about what exactly is going on with these zombie companies. How did we get so many in the first place? What is changing right now that could cause them all to go into bankruptcy, and what can we expect to see in the future? All right, so zombie companies are not as scary as they sound, but basically what you need to know is that these companies do not make enough in profit or in revenue in order to pay back all of their debts or the rest of their bills. This is kind of a big issue because if they don't have enough money to pay back their debts, well, then they're going to go into bankruptcy. So the big question is, how exactly are they even alive to begin with? That is exactly where the zombie term comes in. Investors, investing firms actually come in and prop up these zombie companies, continuing to basically string them along until they're one, profitable, or investors decide to pull out and then they ultimately die. Now, over the last couple of years, we have seen a massive rise in these zombie companies because of really low interest rates from the Federal Reserve. When the pandemic started, the Federal Reserve dropped their benchmark interest rates to 0% to kind of incentivize that economic activity, right? They wanted people to go out and easily be able to get a mortgage because interest rates were really low, but more importantly, they wanted to incentivize business investment. Investors could now invest in businesses really easily because interest rates were at 0%. Investors were going to get a really good return on their money by borrowing more money and putting that money into debt on companies because the return was almost guaranteed with all of their investments. So that meant that many investors and investing firms started to invest and pour money into companies, and companies that probably really shouldn't have gotten money to begin with. Now, initially during the early days of the pandemic, we had companies like GE and Delta Airlines that were being dubbed as zombie companies. These were companies that had to take in billions, if not hundreds of billions of dollars in order to survive. And the reason that they ended up surviving in total is because they had so many employees linked to that business. Now, this is something that has happened before in American history. During the 2008 crash, we had a ton of businesses that ended up going into bankruptcy because of low interest rates years prior. Investors were putting all of this money into businesses that didn't really have solid business models and were taking in way too many costs. Kind of the issue with zombie companies is that as their business grows, well, so does their costs. And this is something that happened to one of the biggest startups in American history, WeWork, just a few years ago. WeWork started off as this massive company that had a valuation of over $45 billion. The problem is it made just enough money in order to cover all of its debts, and when it didn't have that money coming in anymore, now it needed more investor money, which of course drove up its valuation, but it didn't really mean much because the company itself wasn't making enough cash. So what these businesses do to try to continue to stay alive is they just try to get more and more investor money, which is pretty easy when interest rates are low, because as the business stays alive and as that business continues to trade on the New York Stock Exchange or privately, these investors are going to continue to make a lot of money. And that is key to understand here. Investors want to jump in on these companies, even if it doesn't technically make a lot of sense, because they see these businesses as the next big thing. A lot of these zombie companies are your tech startups. So they want to get in on these companies because they want to invest very little with free money and then 10 times their investment over time. They don't want to be left out on the next big thing. They want to take that risk to reward offer and invest in these zombie companies. And of course, they don't start out as zombie companies, but eventually their costs start to outweigh their profits. But what exactly happens when the inverse goes on in your economy and the Federal Reserve starts to raise interest rates? That is exactly the atmosphere that we're in 2022. The Federal Reserve has been very quickly and aggressively raising its interest rates this year. year, and that means that a lot of that investor liquidity is starting to dry up, and that is by design from the Federal Reserve. They don't want as much business liquidity going on right now because that just increases inflation. They want to bring down demand for all of this different debt, so that way we can have lower inflation in our economy, and possibly that means a lot of these zombie companies are not going to be able to survive. Everything is kind of connected in our economy in this way, so right off the bat, with interest rates going up, that means investors are not going to be putting as much money into businesses, right? So that means these businesses are going to have to find ways to cut costs, but we also have a bigger issue with raising interest rates, because what you need to know is that the Federal Reserve does not have a direct impact prices by raising its interest rates and lowering inflation in our economy. The way the Federal Reserve uses its monetary tool of interest rates is by hiking them up or lowering them to bring in demand or bringing out demand. Right now, they want to bring out demand, which means with less investors putting money into businesses, that means businesses cut costs, and usually that means people then don't have an income in order to buy things, and thus inflation starts to come down. But what that also means is now businesses are not going to be getting as much money from sales because consumers don't have as much money either. The big issue with the zombie companies is now they're not going to have any money to pay back all of that debt that they have from investors or investing firms that they've taken on themselves. So now they're not going to have money to pay back investors or debts just in general, which means they're not making enough, and they're probably going to go into bankruptcy a whole lot quicker depending on how high interest rates get. Instead, investors are going to start putting their money into a lot safer options because they have a much higher risk putting their money into these zombie firms. They have to be very careful when interest rates are high, because now with interest rates at 3, 4, and 5%, you got to think investors need a bigger return on their money in order to make any profit. So instead of putting their money in a zombie company that really isn't making any money, they're going to put their money into the blue chip stocks or the companies that are actually being successful on the New York Stock Exchange or just globally. But there is one other thing to consider here with interest rates going up. So obviously there are lots of zombie companies on the New York Stock Exchange right now. There's obviously a lot of private firms that you could consider zombie companies. But with interest rates starting to go up, that means all businesses on the New York Stock Exchange and across the world are going to be getting a lot less investor money. And this ultimately could push a lot of companies that were on the verge to become zombie companies in 2023. Businesses of all size take on investor liquidity. That's why we have that valuation number to begin with. You got to think Apple. Apple is valued at well over $1 trillion, and that is all investor money that is pouring into Apple. But if that money starts to disappear, then Apple is not going to be growing as fast as they were before. Of course, Apple still has a lot of investor liquidity. Apple actually has a business model that makes them profits and revenue. But what about the companies that are on the verge? I'm thinking companies like Uber. Well, like I said, with investor liquidity kind of drying up, a lot of these companies are now going to be sucked into this zombie cycle, and depending on how long the interest rates stay really high, we could start to see even more companies die out and go into bankruptcy, which is a big problem for our economy because that means more and more people are going to lose their jobs all at once. What it means for the future, though, depending on how long these interest rates stay high for, is actually a little bit of a healthier scenario for the stock market as a whole. Like we saw during the 2008 crash, well, a lot of companies that were considered zombies ended up dying off, but it took them several years to get to that point. They went into bankruptcy, but not all at once and not immediately. Now in 2022, a similar situation might happen. We might have a fallout period of a few years, depending on how long those interest rates are high for and how long inflation is also high. Eventually, though, these business models and these companies that don't make any money and don't have any revenue will all disappear, and all that you're going to be left with is companies that actually have solid business models, meaning it gets a little bit safer for investors to put their money on the New York Stock Exchange or across the world. They don't have to worry about companies that aren't making a profit anymore, because all of them are, because they're still here in a really, really high interest rate environment. And like I said, this is a situation that we really have to consider into 2023, because if we are on the verge of a recession because the Federal Reserve is raising interest rates, this could push us even faster into one and make it a whole lot harder to recover from a recession, because we don't know when these businesses are going to have their debt payments due and eventually not be able to pay them and then go into bankruptcy. That can kind of prolong a recession depending on how many of these zombie bad companies you have in your economy. Now, I will say, according to Goldman Sachs, in the United States specifically, zombie companies are not as high as they were, say, in 2021 or in 2020. There has been so much money printed in the US that a lot of these companies have been able to play it safe, but that's not to say that it can't change and that a lot of these companies that are on the verge and are not technically zombie companies don't become that in the next coming months because interest rates get so high because inflation is so stubborn. And that is ultimately going to trickle into every aspect of our economy because now investors and real estate companies and the commodities markets and Bitcoin and cryptocurrencies are also going to start falling because there's just a lot less money. No debt is being paid off, and well, sales are not happening either for just about any business. So what that is all leading to is eventually inflation coming down, but also a lot less business growth in the United States and thus the entire world. And it could mean a complete shift in our business model and our economy and the stock market for the future. No longer will we have a lot of these companies that just get strung along because they have a good idea. They also need to have a good business model, and right now with inflation staying really high, it also looks like the Federal Reserve is going to continue to raise its interest rates and keep them there for the extended future, and that means less business growth, and it also means that there is not going to be as many of these zombie companies in 2023 and beyond. Because you got to remember, from 2008 to basically 2015 or 2016, we had extremely low interest rates. That created hundreds, if not thousands, of these zombie companies. A lot of them went out of business during the 2020 pandemic recession, but now we might see another massive wave of bankruptcies like we have never seen before. But that is it for today's business and financial news breakdown. Thank you so much for watching. If you want to stay up to date with all the top business and financial news from around the country, our team puts together a free daily newsletter, and you can subscribe to it by clicking the link in this corner right here. And if you want to stay up to date with me and everything else happening in the business and financial world, I'm putting out updates 7 days a week over here on this channel, and I've actually got another one ready for you right here, so be sure to check that out before you go. That is it for me, everybody. Be kind out there, and I'll see you all in the next one.